Hey love, I'm Leanne, I'm a CPA, and this channel is where we talk about the emotions and the math behind your money. And today I want to talk about SpaceX, which went public on Friday, June 12th. Likely your timeline is already full of people saying, hey, you already missed out, or you need to buy in right now. But before you do anything, watch this, because the numbers behind this IPO tell a very different story than the hype. Quick note before we start, this is financial education, not advice for your specific situation, so always work with a qualified professional for the decisions that are specific to you. So what is an IPO? IPO, it stands for Initial Public Offering. And when a company is private, only certain investors have a chance to hold on to the shares. They're usually wealthy individuals who got in on the ground floor, venture capital firms who have financed the business as it has scaled and grown, or employees who are often there from day one, taking salary in the form of shares. The IPO is the moment that company opens up for ownership to the public by listing its shares on a stock exchange. And from that point on, anyone with a brokerage account can buy a piece of the company. The company sets a price per share, it raises a large amount of money from that sale, and it begins trading publicly. SpaceX set its IPO price per share at $135 and raised $75 billion. That's the largest IPO in history. Just at that moment, the price is set. Everything after that is what the market decides that share is actually worth. So what is SpaceX? SpaceX also now includes xAI, Musk's artificial intelligence company, and the social media platform formerly known as Twitter. So what you're buying when you buy SpaceX stocks is not just rockets. You're buying a bundle of businesses, one profitable, the other one's mostly not. So keep that in mind, because next we're going to talk about the math behind its current valuation of $2 trillion. So let's figure out some of the numbers to figure out how much you are actually buying with a share in SpaceX. So in step one, we actually calculate the amount that was raised in the public market. So SpaceX actually sold, it created additional shares of 555,555,555 shares. Those are what was offered up to the public, and it offered them up at $135 each, which means 555 million times $135 a share. That equals $75 billion that were raised on its initial public offering or IPO. In step two, we can use that to figure out what the company is valued for, its valuation, or its market cap. So what we do is we consider all the shares that SpaceX actually has outstanding. So even though it's offered 555 million, it actually has 13 billion with a B shares outstanding. These are not just the ones that were sold in the IPO, but it's every share in existence across all of its shareholders, its employees, or insiders. So in order to get its valuation or its market cap, you can take this 13 billion shares outstanding times $135 per share to get $1.77 trillion at the IPO price. The shares sold represent only about 4% of all the shares outstanding, which means most of the shares, 96%, are already owned before a single public share was actually sold. And when the stock closed on Friday at $161 over all the 13 billion outstanding, it means that in a day, the valuation of SpaceX went to 2.1 trillion with a T. So what are you actually paying for? SpaceX is trading at 112 times last year's revenue. And last year it lost $4.9 billion, with total losses since its founding at over $41 billion. For context, when Meta went public, it was growing at $88 and traded at 28 times revenue. Google was also growing at 240% and traded at 10 times its revenue. SpaceX at 112 times its revenue while losing money is not a valuation based on what the company is doing today. It's a bet on what it might do in the future. But one of the biggest numbers in the prospectus, so the document that anyone who wants to invest in the company looks at, was the claim that the total addressable market of SpaceX is $28.5 trillion, which they call the largest actionable total addressable market in human history. For context, what is 28.5 trillion? Well, it's roughly the entire annual GDP of the United States. Here's the breakdown of how that 28.5 is represented by the different business units. So 370 billion with the B is representative of their space business. 1.6 trillion is the connectivity or the Starlink business, the profitable one. And 26.5 trillion with a T is AI. So 26.5 trillion, nearly 93% of the entire TAM figure, total addressable market, comes from AI, a business that SpaceX didn't compete in until it absorbed xAI 6 months ago, along with all of its losses. NYU valuation professor, hopefully I'm getting this right, Aswat Damodaran, one of the most respected voices in finance, said seeing the 28.5 trillion TAM figure made him think the prospectus was written by Grok AI rather than a banker. Quote, "This is a hallucination, and I would be embarrassed to even put that number out." End quote. The valuation is not based on what SpaceX is, but it's based on a version of SpaceX that doesn't really exist yet. Let's dig a little bit deeper into those numbers. Essentially, the fundamentals. What is the business actually telling us? So SpaceX made a profit of $791 million in 2024. Then in 2025, after acquiring his other businesses, Elon Musk's AI company xAI, it swung a net loss of $4.94 billion on revenue of $18.7 billion. And in just the first quarter alone of 2026, it lost another $4.3 billion. Starlink, the only profitable part of the business, is generating about $4.4 billion in operating profit in 2025. It's effectively subsidizing everything else. The AI segment alone recorded a $6.35 billion operating loss in 2025. So what you're being asked to pay for in a $2 trillion valuation is one division that's making money while the rest are just burning through it. In that prospectus, there were actually two warnings in relation to government dependency. SpaceX's IPO disclosed that 1/5 of its 2025 revenue came from government agencies, and the company warned in the prospectus that businesses with government entities are subject to changes in policies, priorities, regulations, mandates, and funding levels. This is not just risk, it's actually space origin story. SpaceX's first major windfall was a $278 million NASA contract in 2006 to develop the Falcon rocket and Dragon capsule, the first of more than $500 million in grants from NASA when the company was nearly out of cash. The Washington Post, and I've included a lot of references in the description, it found that Musk and his businesses received at least $38 billion in government contracts, loans, subsidies, and tax credits for more than 20 years, often at the exact moments that companies would otherwise have failed. As one early Tesla investor put it, there would not be Tesla or SpaceX if it weren't for the government. And the mistake the government made was that they should have had an equity stake, unquote. Musk has poured personally $300 million into helping elect Trump and has remained close with the president, a relationship that has helped him secure contracts to today, but could become a liability the moment that the political winds shift. Government favor is not a business model, it's essentially a dependency. So warning one is that outside of one business unit, the company is losing money at an accelerating rate. And warning two is that a meaningful chunk of revenue depends on continued government contracts that can be changed, terminated, canceled. Another thing that's really interesting is the governance, essentially who actually controls the company. When you buy SpaceX stock, you're actually buying what is a Class A share, where you get one vote per share. Musk controls Class B shares, which carry 10 votes for each share, giving him 85% of all the total voting power while only owning 42% of the equity. So what does this mean in practice? Well, a number of people who've looked into it, including CalPERS, California's massive public pension fund, has said in a formal letter that removal of the company's most powerful officer would, as a mathematical matter, require his own vote, essentially making him unfireable without his own consent, unquote. This level of control is actually more concentrated than any other tech company that we've seen, more concentrated than Meta, Alphabet, or Snap, and those companies are already attracting tons of criticism for their weak shareholder accountability. You're not buying into a company where you can have a meaningful say. You're along for the ride wherever Musk decides to take it. Another aspect that makes this IPO a little bit differently is the allocation to retail investors. Normally, retail investors, everyday people like you and me, get about 5 to 10% of an IPO. The rest goes to institutional investors like pension funds, hedge funds, or large asset managers. SpaceX initially earmarked around 30% of its shares for individual buyers, which is triple the typical proportion. That number was trimmed down to a low 20% range because institutional demand was actually very intense. But it's still historically unusual for a deal of this size. And why does a higher retail allocation matter? Because the retail investor actually takes on more downside risk, not institutions. Normally in an IPO, they increase the amount of money that you have to set aside to invest it. But in this case, brokerages, where you actually go to buy and sell these shares, drastically eased its access. Fidelity lowered its eligibility threshold from $500,000 to just $2,000. US brokerages like Robinhood, SoFi, and E-Trade required no minimum account balance at all. Those minimums exist for a reason, because IPOs are volatile, they're high-risk investments, and thresholds were a layer of protection, ensuring that only people who have sufficient financial cushion could participate. Removing them doesn't actually democratize investing, which is sometimes the argument you hear. It actually removes a guardrail where it is meant to protect people who can at least afford to lose money on a speculative bet. And why am I using the word bet? Because the history of performances of IPO is quite shaky. A Reuters analysis of the 25 largest global tech IPOs found that 16 of them declined in their first 12 months from their debut day closing price, with 8 of the 10 biggest falling between 25 and 71%. And even the ones that initially held up often didn't hold those gains. Truist Advisory found that every major tech IPO in the last 15 years saw double-digit drawdowns from the peak, averaging a 55% decline. The pattern is stock debuts with excitement, woo, it climbs initially, then reality sets in. And the people holding on when that happens are usually retail investors who bought into the hype. So ask yourself, who benefits from making it easier for more retail investors to pile into a money-losing company at a $2 trillion valuation? Trust me, it is not you. By the time a usual investor can buy in, the best returns are usually already gone. The people who made money on SpaceX are the early private investors, the venture capitalists, the employees with stock options, They bought in years ago at a fraction of Friday's $135 price. The IPO was their moment to get to sell. And if you didn't get an allocation at that 135 when the market first opened, because honestly, most retail investors did not, you're buying on an open market at whatever price it is trading at now. So SpaceX, I believe, opened at 150, hit a high of 176, and closed at 161 on day one. So if you bought Friday morning, you are already paying a 10 to 30% premium over the IPO price before the market even had time to sell. And fortunately, this isn't unique to SpaceX. It's essentially how most IPOs work. But the reason why you are not paying attention or believing the hype is because you know that index funds and ETFs are better. Instead of picking the right company at the right moment, index funds and ETFs let you own a small piece of hundreds or thousands of companies all at once. If one company struggles, the others carry the weight. And when the whole market grows, you grow with it. You don't need to predict which company wins. You just need to stay invested. Because the research is clear, time in the market beats timing the market. A low-cost, diversified ETF bought consistently over 10, 20, 30 years will outperform most attempts to pick individual stocks, including IPOs. However, the emotions are real. Fear of missing out is 100% real. And I honestly understand it, but the math almost never supports it. So in closing, SpaceX is losing money outside of that one business unit. It's built on a foundation of government support that now it itself warns could disappear. It's controlled by one person who cannot be removed without his permission. And it's valued at $2 trillion, based largely on an AI business that is owned for 6 months and has a very, very high projection, estimation, fantasy of what it can obtain. None of this actually means that the stock will go down. It might go up, but that's largely people speculating, and it is not investing in fundamental businesses. Your long-term wealth is not built on IPOs. It's built on time in the market. It's built on consistency. It's built on a diversified, low-cost strategy that doesn't require you to be right about any single company. And before you decide anything, there's one more thing about this IPO that most people have no idea is happening. And it affects everyone holding an index fund or ETF, whether they bought SpaceX or not. I'm leaving that in the next video, and you can find the link right here. See you over there.